the narrative of storing value is really Bitcoin's use case. Ethereum's use case is that it's actually going to be used and burned. There's a lot of tribalism in crypto. But before this year, I would have considered Ethereum like a really good, reliable chain, but without any products being built on it, it shouldn't really do well. But because of what's happening with AI and with Wall Street and Project Crypto, I think Ethereum's essentially the value of its protocol layer, like Union Square Ventures calls it the fat protocol, is now going to be more valuable because we're tokenizing everything on Ethereum rather than just gold. So if gold is a $21 trillion market, tokenizing the real world is orders of magnitude larger than gold, which means Ethereum probably will flip in network value versus Bitcoin.
Ethereum plunged below $4,300 after failing to maintain momentum above $4,700, with $338 million in liquidations, intensifying selling pressure. The drop breached a key ascending trend line popularized by Fundstrat's Tom Lee, signaling that near-term technical support is under serious threat. Analysts pinpoint $4,300 as a critical floor, but September's historical weakness looms large. Ether has averaged losses of minus 12.55% during this month, making deeper drawdowns a tangible risk. Open interest contraction and negative funding rates indicate that long positions are being systematically flushed. This liquidation cycle, while painful, primes the market for a potential rebound if spot demand returns. In other words, the market is self-clearing, weak hands exit, volatility spikes, and liquidity resets. Relative Strength Index (RSI) readings remain neutral, and the Ichimoku cloud retains a bullish tilt, suggesting that Ether's technical underpinnings are far from broken. Yet the psychology of September cannot be ignored. Historically, fear compounds sell-offs as traders anticipate the month's signature weakness. This seasonality overlays structural pressure, creating a high-probability setup for either a vicious correction or a violent squeeze. Tom Lee, co-founder of Fundstrat, frames this moment as more than technical turbulence. He sees Ethereum at the cusp of a historic bull run driven by the convergence of Wall Street capital flows and artificial intelligence demand. If this thesis holds, Ether is evolving from a speculative asset into a core global infrastructure, potentially surpassing Bitcoin's network value. According to him, September may be red, but beneath the chaos, a paradigm shift is brewing, one that could redefine Ethereum's place in the financial universe. Let's take you back to the latest Tom Lee's sharp market analysis. Please don't forget to like, subscribe, and enable notifications for more in-depth content. Thanks for joining us again. Enjoy the rest of the video.
Well, Bitcoin has done very well over any 10-year period, and at $100,000 today, it does reflect that institutions are beginning to view this as a legitimate way to store value. Because the Bitcoin blockchain is really one of the best ways to record financial transactions with 100% never failed censorship resistance, never fraudulent entry in its entire operation. So, but institutions, only about 5% actually own any Bitcoin, but 95% of Bitcoin has already been mined. It's a fixed supply. That's a stat from Bitwise. But that 5% that isn't held yet, because the other Bitcoin is basically being hodled, has to be acquired by those 95% of institutions. Plus now governments want to own Bitcoin as a strategic reserve. So if you think about how difficult it is going to be to acquire that last 5%, I can see why it would replace gold or equal the network value of gold, which is over 22 trillion, and that would put Bitcoin at around 1.2 million.
In the short term, if the president continues to interfere with the Fed, is that a short-term catalyst, or are these strategic long-term arguments for Bitcoin what really matters?
It's in the short term, it's probably unclear if it helps or hurts Bitcoin, because Bitcoin also is correlated with global monetary liquidity. Raoul Pal at Real Vision put up this chart years ago that shows M2 versus Bitcoin, and it's been almost dead on at all the bottoms and tops. So once we would be through Fed interference and the Fed is easing, of course, that's good for Bitcoin. But in this period of risk off, I would say it would hurt stocks and Bitcoin. Ethereum differs from Bitcoin. Actually, Ethereum was initially a fork of Bitcoin, by the way, but with an added feature, which is smart contracts. So what they wanted to do on Ethereum was to say, let's use blockchain technology not just to store value, but now to store information. Ethereum is as a smart contract platform, actually also has something called the EVM, Ethereum Virtual Machine. So you can run entire programs and conditional contracts on Ethereum. And Ethereum itself is 100% reliable. It has not had a single moment of downtime since inception. It's one of the few blockchains that has never been down. And then if you needed to do more things on Ethereum, you can build what they call layer 2s on top of it. So Ethereum is essentially infrastructure that now is catching the attention of two industries. The first is the financial sector. The stablecoins became really a breakaway product for crypto. And that's like the ChatGPT moment. There's $250 billion worth of stablecoins. The vast majority of those are minted on Ethereum. Then the Genius Act was passed by this administration and this Congress, and that greenlighted the proliferation of stablecoins onto the blockchain. So banks are now building stablecoin products. That Treasury Secretary Besant thinks that could get to $4 trillion. That's exponential growth, burning gas on Ethereum. And then we have Project Crypto, which is the SEC wanting Wall Street to build on the blockchain. Now, all that collectively, from a Wall Street perspective, is like 1971 for the dollar. And what I mean by that is, in 1971, the dollar went off the gold standard. So in 1971, the dollar became synthetic. And gold was what people bought as a hedge against that synthetic dollar. So you had gold as the trade, and that would be the Bitcoin equivalent. But actually, the synthetic dollar is what created the rails for Wall Street to build all their future products. The futures, curves, derivatives were all because the dollar was a synthetic product. If the dollar was backed by gold, Wall Street would be still a very small business. Well, Wall Street now is going to be building its entire infrastructure onto the blockchain. And the blockchain they're choosing is Ethereum. So this is the 1971 moment where Wall Street is essentially capitalizing on tokenizing the entire world onto a blockchain. That's a huge opportunity. The second story arc benefiting Ethereum, though, is AI, because now we're moving towards an agentic AI world, but with real products. Like AI is principally been trained on like internet and, social media. But it hasn't been in the real world because it hasn't ingested us as we moved and physically moved or even have independent products. That's a vast amount of new information for AI models to ingest and store. But then now you have to be sure that all the instructions being sent back to the robot are proof of the originator. In other words, you need a token. LLMs use tokens anyways, but now you need like a token that interacts across chains. And that's where AI is going to build on Ethereum, because you essentially need what they call proof of human. We need to prove that this lawnmower got a real instruction from another chain or another vendor. And so that is all being built on Ethereum. This is not going to be a popular statement because there's a lot of tribalism in crypto. But before this year, I would have considered Ethereum like a really good, reliable chain, but without any products being built on it, it shouldn't really do well. But because of what's happening with AI and with Wall Street and Project Crypto, I think Ethereum's essentially the value of its protocol layer, like Union Square Ventures calls it the FAT protocol, is now going to be more valuable because we're tokenizing everything on Ethereum rather than just gold. Like, so if gold is a $21 trillion market, tokenizing the real world is orders of magnitude larger than gold, which means Ethereum probably will flip in network value versus Bitcoin.
Lee explains his thesis through two huge turning points. The first is Wall Street's adoption of blockchain at full scale. He calls this the 1971 moment, just as the end of the gold standard changed finance forever. When the dollar left gold, it did not collapse. It grew into a system that created derivatives, futures, and entire markets built on trust in the dollar itself. Lee believes something similar is happening now with Ethereum. Wall Street is building its next phase, focusing on stablecoins, tokenized assets, and new forms of settlement, primarily on the Ethereum blockchain. This is not a theory. It is happening in real time. Legislation like the Genius Act has already cleared the path, and Treasury Secretary Besson projects that the stablecoin market could grow to $4 trillion, with almost all of it sitting on Ethereum rails. The second force is artificial intelligence. Lee says that as AI becomes more autonomous, it will need a secure and verifiable way to communicate and store instructions. Ethereum, with its record of uptime and support for smart contracts, offers the perfect proof system for machines communicating with each other. It is the missing trust layer for AI, and that could push usage and value to levels Bitcoin cannot match. The race is no longer about which coin is digital gold, but which one powers the world. Let's watch more clips from Lee's interview to gain more insight.
I think that the distinction to make is that I'm not bearish on Bitcoin because I think Bitcoin will get to 1 million.
But what about all the other cryptocurrencies?
Well, other cryptocurrencies don't have the network value because otherwise they're just software chains, meaning...
So you don't really believe in Ethereum as a currency. You believe in it for other reasons.
That's right. Yeah, I think that the narrative of storing value is really Bitcoin's use case. Ethereum's use case is that it's actually going to be used and burned. So Ethereum gets consumed through gas fees, and then staking is how you produce an Ethereum. That inflation rate has been below Bitcoin, actually. So if you look at it as monetary supply, Bitcoin's monetary supply is actually still growing faster than Ethereum. If I could give a little historical perspective, when Tether created the first dollar stablecoin and they built it on Ethereum, their idea was someone doesn't always want to be long Bitcoin or another crypto. They want to be long something stable. And crypto holders weren't really allowed banking access. So they didn't have an off-ramp. So Tether built a dollar-backed coin called a stablecoin, USDT. Mm-hmm. In 2017, Google and the UT Austin wrote these papers claiming Tether was just a fraud. And the only reason crypto went up was because of Tether creations. Okay, so in other words, it was immediately tried to be viewed as something fake. But then Tether has since grown, and of course stablecoins have really grown in popularity. Merchants outside the US love stablecoins because they don't suffer the chargebacks. You know, credit card companies merchants eat fraudulent transactions. So merchants, they get paid, it's just as good as getting $1. In Turkey and a place like India, Tether trades at a premium to the dollar because people prefer to get that over cash because it's hard to get robbed. You know, you can use a stablecoin to buy real estate in Dubai now using Tether, like $100 million transactions. So it's actually being used in the real world. Actually, stablecoin usage, 80% is outside the US. But the reason the US administration starts to like it is, number one, crypto is essentially 100% quoted in dollars. In GDP terms, the dollar is 27% of global economy. Mm-hmm. It's 55% of central bank reserves is the dollar. It's 80% of traditional financial market pair quotes. So the synthetic dollar, which happened in 1971, made the dollar 80% dominant. In the crypto world, the dollar is 100% dominant. So the US wants us to financialize into crypto because everybody prefers to get $1. Collectively, the stablecoin industry is about $280 billion of outstanding dollars. They are now the 12th largest holder of treasuries in the world. Japan owns 1.2 trillion of treasuries. Treasury Secretary Besson thinks this market will get to 4 trillion. That would make stablecoins the largest holder of treasuries in the world. So it'll be backstopping the entire treasury market soon.
Now, Lee makes it clear that he is not turning his back on Bitcoin, and he warns against misunderstanding his view. He still believes Bitcoin has enormous upside, repeating his long-standing prediction that it will eventually reach $1 million, as institutions continue to pile in. Its fixed supply becomes even more valuable in a world of money printing and debt. However, he also distinguishes between Bitcoin and Ethereum in a way that highlights the significant differences in their roles. Bitcoin is digital gold, the ultimate vault where people can store and protect their wealth without interference. Ethereum, however, plays a different game. It is not just stored, it is used. Every action on its network consumes fuel, whether it is a payment, a smart contract, or a tokenized security. That constant burning of gas is what Lee points to as Ethereum's defining strength, because demand rises with activity, and activity is exactly what the future of finance and technology is built on. This is why Lee believes Ethereum could one day flip Bitcoin in overall network value. He argues that if Wall Street moves ahead with plans to tokenize trillions of dollars in assets, from stocks to bonds to real estate, artificial intelligence systems begin depending on Ethereum to verify and secure their instructions. In that case, the pressure of demand flowing into Ethereum will be unlike anything seen before. It would not just compete with Bitcoin's buy and hold model, it would leave it behind. The size of this change could grow larger than the gold market itself, because it is not only about storing value, but it is about creating new value every single day. Bitcoin will continue to act as the ultimate shield for wealth. Still, Ethereum is shaping up to be the engine that builds financial products, powers AI-driven economies, and supports the digital infrastructure of the future. For investors, this is not about picking one side of the fight. Both have roles that grow more critical by the day. Bitcoin remains the hedge, the scarce digital asset, with unshakable appeal to those who want protection against the failures of central banks and governments. Ethereum, on the other hand, is moving into a position where every new wave of financial and technological growth passes through its network. That is a different kind of value, one tied to usage and necessity. And no, Tom Lee is not suggesting that the world will suddenly abandon Bitcoin or that its role will fade into irrelevance. What he is pointing out is that the market may eventually recognize and reward Ethereum's deeper utility in ways that even the most confident Bitcoin believers may find surprising. For years, people assumed the hierarchy in crypto was unshakable, with Bitcoin locked at the top. However, Lee argues that this assumption could be tested. If his vision proves correct, Ethereum will not merely sit alongside Bitcoin as another strong digital asset. It will become the engine room of a much larger system. That system could extend from Wall Street trading floors, where trillions in assets are tokenized, to the networks where AI machines communicate and verify their actions. The real question, he says, is shifting away from which coin is the safest to hold, to which one the modern world cannot function without. Thanks for watching. Don't forget to like and subscribe.